Well, good evening and welcome to the Digital Finance Analytics pre-show. Thank you for joining. Those who are already on, I'll acknowledge you in a moment or two. And we're just getting ourselves sorted out, set up. Tell me whether you like the background. I thought I'd go informal tonight, considering the occasion. So I don't have the blue-green screen, if you see what I mean. You've got a shot of my lounge in the background, but I thought that looked pretty good. So tell me what you think. Right, who's on? Let's have a look. Joe, I saw. Hello, Joe. A few from Robert Barwick says, is there any truth of the rumour that the Bank of England has disposed of John Adams by covering him in molten gold? Now, that's an interesting one. Yeah, anybody seen John Adams? Heard from John Adams? He's gone extremely quiet. I'm not quite sure why that is, but I'm a bit suspicious. So there's Putney Gunn talking about bail-in. Yeah, we'll definitely talk about bail-in once again. Neil, hi to you. Zoe Zhang. Scenarios, bail-in and bail-out. Yeah, funny. Isn't it how interesting how bail-in is one of those things that everybody wants to talk about? Darius, hi, yes. Good question on M1, M2, and we'll talk about money supply perhaps as well. Brad Pack wants to talk about Newcastle. Yes, okay. Hi and good morning. So you must be in another part of the world then. I wonder where you are. Gemma wants to... is it a good time to buy or is the price right? Want to minimise the mortgage. We're 2 hours south of Sydney. Yeah, interesting question. We'll try and cover some of those things. I'm Lost. Hi, good to see you. Gemma wanted to get on top of the question. If I haven't answered the question, ask me again, all right? Hi to Aaron, Jason, Adam, Mark, Kazim, Joytech 22. Thank you for pointing out my microphone was on. Yes, I had it on rather than actually the audio follow video, which is what I should do. YouTube Junkie, Tankeen, Tessa, Olivia St. John, hi. 500 viewers, I wager, tonight. Well, we'll see. We certainly got a good number last time around. Moet, Adam, Melbourne. I'm Lost in Melbourne. Jason from Wellington. Christchurch, New Zealand. Perth. Kazim from Melbourne. Good to see a few people on from various places. That's great. New Zealand... Is the New Zealand dollar strong enough, says Mark. Very good. Okay, very good. Okay, just going down the list. There's a few more. Adam, Eva Gardens, Jason Frick again. Hello, yes. David from Cairns. I'm fired up. I'm ready to go. I'm just going to give this just a couple more minutes. People sometimes don't get on the stream on time and then complain. Gemma's from Gerringong. Oh, okay, yes. I actually looked at Gerringong, ended up at Thirroul rather than Gerringong, but a nice part of the world down there. Leighton's at Wide Bay up in Queensland. Brisbane. Dan's from Warrawood. Kevin's from Ipswich. The Northern Beaches guy. No, I wonder where the Northern Beaches... probably Sydney Northern Beaches, yeah. Yes, he says, contact agent is on most of the signs these days. Yeah, you're right. It's very interesting what's happening at the moment. Miles is from Alternate in Melbourne. Another one from New Zealand. Great. Good. Nice to see the New Zealand community expanding. Obviously, Joe's doing magic work over there. More to come. Another couple from Melbourne and Sunshine Coast. Great. Okay, so I'm just going to last out one more minute and then we'll go. Ash from Canberra. Hi, Ash. How you going? Somebody from Tel Aviv. I'm not sure. Yes, okay. Oh, could be. Lake Macquarie. Hi, Jack. Auckland. I'm sorry, Matthew. Yes, it's a bit later over there. The reason I do Tuesdays is because this Tuesday is because normally I get the Reserve Bank minutes, but not today. And 8 p.m. seems to work for most people, but I'm happy to consider other scenarios if there are better times for people. Narrabeen. Hi, James. Luke is in far north Queensland. Bruce Parks is New York. Oh, another Wellington. Joe, you need to go to Christchurch, according to Quali. I think that may be on your list at some point, at least the South Island more generally. And Michael says, do I invest in anything? Oh, I'll tell you a little bit about that. Okay, so I think we've got enough to make a quorum. So this is now where I move from the pre-show, and I'll put a comment below in the final version of the stream as to when the formal show starts. So now I'm going to push this button and hopefully we get the magic intro. Fingers crossed. This is where I hold my breath. See whether it works. And good evening and welcome to the Digital Finance Analytics live stream for January the 15th, 2019. Great to have you on board this evening, and welcome to the first one of 2019. We've got quite a few on board already, and I've, in the pre-show, welcomed a few people on. What I'm going to do now is to look away from the chat screen just for a few minutes and give you just a short introduction. Won't take long, but just a few things I need to cover, so I'm going to move into that swiftly now. And by the way, the pre-show comes up when I go live, so I go live about 10 minutes before the official time, just to make sure that everything's working well. Seems to be okay at the moment, which is good to see. So what I want to do is just quickly talk about today and what we're going to do. So we're doing this introduction. I need to cover the house rules. Just a little bit about our models, because people keep asking me about how we do what we do. I'll then pull out a few key slides and just talk to those and give you some context for the broader Q&A session. And then we'll go to questions and answers. The bulk of the time tonight, probably an hour to an hour and a half, will be questions and answers. I do have quite a few questions but I'll also take them on the live chat, and there are some of people have already asked as well. And then we'll sign off, and hopefully we'll all be done by about 9:30 Sydney, if that makes sense. Okay, in terms of house rules, just a quick thing to say. Please note this isn't financial advice. I'm not qualified to give it. I can't give it. This is just my own opinion, my own views. Do a lot of research, do a lot of analysis, but please understand that this is not financial advice. I don't know your individual circumstances, and I'm legally barred from giving financial advice. Secondly, please do play nice in the chat room. No racial slurs. We did have some last time around. We are moderating the chat room, and we're going to be a bit more aggressive this time, including, if necessary, kicking people off completely. Don't want to do that. I want to encourage a free-flowing conversation, but if people start to get nasty, then we will take action. 15th of January 2019, so if you're watching this 2 or 3 years later and things are completely different, well, this is what it looked like tonight. And if you want to get my attention through the chat session, use @Walk the World. There's a lot of toing and froing on the chat, and quite often I won't be able to follow everything that's going on, so I do try to look at the Walk the World. So that's the way to get hold of me. Just quickly on the model, we survey households all the time. We incorporate information from lots of different sources. We run our core market model, and that then drives our industry reports, the blog, and everything else that we do, and a lot of the posts that we do create for the YouTube channel. We cut it, slice it, dice it all ways, from segments, from locations, from property status. I only cover Australia at the moment, although I'm interested in the possibility of potentially trying to do something in New Zealand too, because there's a unique perspective that you get when you look at it from a consumer perspective rather than from a bank perspective, and that's what we do. We start from consumers. So quickly, just a few highlights. Credit growth overall is 4.9% in housing. Of that, 6.8% is owner-occupied and 1.1% is investment. Now, this is important because a lot of people are saying, oh, there's no lending, the bank should be freer. No, actually, the banks are still lending up 2 or 3 times inflation at the moment. So let's get that clear. There is still a lot of lending going on. The momentum is slowing, and therefore the credit momentum means that effectively home prices are more likely to fall rather than rise, but banks are still lending. We look at our household confidence indices, and this is one of the ones that I quite like because it identifies that those without mortgages, the free affluent, those who have a property but no mortgage, are still more confident. They're above the 100, which is neutral, but their confidence level is diving. People with mortgages, their confidence levels are now well below 100, and if you split that out between investors and owner-occupiers, investment property owners are now lower than those renting, and you'll see there that renting has just come up a little because essentially some people are now getting cheaper rentals than previously. So this is a really important barometer in terms of people's confidence with regard to the financials and their financial status. Mortgage stress continues to rise. We published this last week. 31% of households are now in mortgage stress, in other words, have cash flow issues. That's more than 1 million households. And despite the fact that the Reserve Bank reported that the household debt-to-income ratio dropped very slightly, we are still in extraordinary territory with very, very high levels of debt. And it's quite concentrated in certain postcodes and certain types of households. But this is a big deal, and this tells you that in a couple of years' time we're going to see more defaults, I think. Now, the Reserve Bank published their monthly chart pack, and this is the chart I always go to. Basically what it tells you is that consumption is running ahead of disposable income. So people are spending more than they have available. That's why they're dipping into their savings. And that trend has been going on for some little while because effectively we don't have much in the way of income growth. But consumption is still there. But interestingly, the retail area seems to be under pressure. This is data on monthly footfall, and you'll see there that there was a significant dive in December. And that's, I think, because a lot of people did their shopping in October and, the Black Friday sales online. I suspect retail figures for December will be quite a lot lower. In terms of home prices, we're still seeing further falls. This is the chart I put out at the weekend. It's worth saying that it varies by location. Hobart isn't on this one because the CoreLogic indices doesn't actually include Hobart. It should, but it doesn't. Hobart's doing a little better than the others. But really, other than Adelaide, no one is really seeing any price gains now, and other than Hobart as well, of course. And Sydney's down, peak to trough nearly 12%, Melbourne 8%, Perth is nearly 16%, and Darwin is 25% if you had them too. So we are still in a falling mode. My view is home prices will continue to fall, and the rate of acceleration of fall looks to be increasing, particularly in Melbourne. Household wealth is continuing to fall. This is on the left-hand side. It's the chart from the Reserve Bank that shows that financial assets are okay, although, of course, that was before the stock crash towards the end of the year. But dwelling prices are falling, so net worth is falling, and we're seeing that in our own surveys through our net assets. So you can see there that the number with higher net worth is dropping, and those with lower net worth is rising. Business investment continues to slow, contrary to what people say. And in fact, the reason GDP is so strong is simply because of government investment, which isn't very healthy, actually, long term. Consumer sentiment and consumer GDP is probably going to fall ahead as well. And the BBSW, the funding is still out of kilter with 29 basis points. It was 32 basis points a week ago. So that means that there's still more bank funding issues to deal with. And we'll talk about that a bit later. Financials are below their peaks, well off their peaks. In fact, they're back to where they were in 2012. This is the index, the ASX 200 Financials Index. We have a lot of downside risk on the financial sector, in my view, from this point forward. And we'll talk about the Royal Commission because that's one of the critical issues. Bond rates are also now higher in the US than here. That's really unusual. And that basically means that international investors are going to look more to the US than Australia. We always had a risk premium here and paid more, but not now. So that's a big deal. And that's one reason why funding is quite complicated. Okay, just quickly now onto our scenarios. This comes off the back of the research universe that I explained earlier on. Those of you who've been following me will know that I run these scenarios not to give you a definitive point, but to give you a flavour of the range of things that we're seeing. And essentially, we come to these scenarios from business as usual down through to Doomsday Iceland 2.0, as we call it. And then we look across various dimensions. What I'm going to do is I'll just highlight where things have changed. So business as usual, so this is basically the gospel according to the Reserve Bank, I guess, would suggest that things are reasonable. Home prices are down a bit, but not dramatically. Unemployment is quite low, and the Reserve Bank keeps its rate where it is. But I only give that a 2%. It was 2.5% last month. So there's a very little chance in my mind that we're going to be able to hold to business as usual. My next scenario is that things only get better. Now, what I've done here is cut the RBA rate. I think that we're likely to see an RBA rate cut quite soon, maybe even as early as March now. And I've also given that now a 20% rather than a 25% rating. So I'm basically less confident that we can get away with this level of outcome with a set of house prices on average from peak to trough down 15 to 20%. The next one is not yet doomsday, and this is where now the Reserve Bank drops its rate to 1%, and the bank losses are higher, and now I've put that probability at 47.5%. So this is my basically mainstream scenario now. This is basically saying if we don't have massive international issues, home prices could be down 20 to 30% peak to trough over 3 years. And by the way, one bank could well be bailed out. Then we look at Armageddon, Ireland 2.0. So runs similar to what happened in Ireland. And there we have rates close to zero. We have bail-in and bail-out going on. We have bank losses rising. Probability is 20% on that one, up from 17.5% last time. And then we have our mother of all collapses, where basically we have zero and below in terms of rates. We have quantitative easing. We have lots of bank failures, and this is, I guess, like Iceland would be Iceland 2.0 is what I call it. I give that a 5% chance at the moment. So it's not my central case, but it's one that I do model and monitor, and that's where I think we are at the moment. So my central case is that we're in not yet doomsday place. So home prices peak to trough 20 to 30%, and it varies of course by location, but that's pretty much the way it runs at the moment. Okay, so I'm going to now switch back to the live Q&A, and I'm going to go back and just have a look at some of the comments, questions, and then we can start answering hopefully some useful conversations. Okay, how long will the downturn last, says Cody? It's a very good question. I think that this is not going to be a short, sharp sort of spike down and then a spike up. I think this is more like a Japan scenario. I remember even in the UK where they had the GFC in 2008, effectively a decade later, they're still trying to deal with the fallout. And indeed, there are people in the UK and in Ireland who still are in negative equity even now. So to my mind, this is going to be a long, slow slide and then a bounce along the bottom. And it could be a lost decade. It certainly could be a lost 5 years, in my view. Tricky times, I think. I'm lost like the tropics in my window. Jolly good. Yeah, I thought it was quite nice. It's just a little different from the normal one, better than perhaps my kitchen previously. Russia buying Bitcoin. Yeah, I don't know much about that. I know that they have been buying up and also other assets too, as indeed China has. China's been buying gold as well, of course. So it looks to me as though there's a bit of a swing going on, and I suspect all of this is a play against the US dollar ultimately. There is a school of thought that says the US dollar will at some point quite soon cease to become that cornerstone currency that it is at the moment. And then people are looking at alternatives, and those alternatives could be gold, it could be something different, it could be a cryptocurrency or something, but who knows. Okay. Data about the Northern Beaches. Yeah, I've got some data on that. So I've noticed that we are beginning to see some oversupply of property coming onto the market. So there's a higher listing ratio in the Northern Beaches. We're not seeing that many falls at the moment other than at the top end. So if there's a property of 1 to 1.5 million or higher, then we are seeing price falls. We also notice that there are quite a lot of people keeping property on books for a lot longer. So my expectation is that we will see further slides in prices. I suspect that some of those smaller places will hold their value better, particularly some smaller houses. But some of the more expensive ones will probably slide further. And I'm also watching some of the newly constructed units, which seem to be probably more than's needed at the moment. And I suspect some of those could slide too. So I think you are seeing the start of a slide, but it's not as severe as Western Sydney. Okay. Now, I think I comment on this Northern Beaches guy said that a lot of people, a lot of agents are now saying, contact us for pricing. Yeah, there's a lot less information now readily available about where prices are. You've got to look quite hard. A lot of agents are now refusing to advertise or even suggest prices. They're basically saying, have a conversation. And that's because overall we're seeing prices slide. Now, the average of 10 to 12% drop in Sydney is masking massive differences. So we know that there are some postcodes, for example, around Liverpool and Campbelltown, where prices now are down more than 20%. And that's units and houses, particularly some of those on small lots, those houses on small lots. We're also continuing to see unit prices slide in and around places like Ultimo, now at 21 or 22%. Bondi, we're seeing units there under pressure as well. And we're also seeing continued slides up in the Central Coast. In Melbourne, we're seeing quite a lot of downside movements in Melbourne look to me to be moving down smarter than Sydney, although it started later. And at the moment, it looks to me as though, again, the top end of the market is moving down the fastest. But I'm also already seeing, for example, I did some work the other day for somebody to look at northern Melbourne, and there, home prices, which were sort of about 1.3, are now down 1.1 or thereabouts, whereas units, which were around sort of 450 or 420 in that sort of range, haven't moved very much at all at the moment. So it looks to me as though the top end of the market's moving first. But I suspect that will flow on down, because essentially as you take the top end out, it tends to sort of spill down into other areas. Now, of course, in Western Australia, there, prices are down at least 15% from their peaks, but it's been 5, 6, 7 years, and I'm still getting reports of prices continuing to slide, and I'm also getting reports of further difficulty with regard to rentals. So rental streams are also being reduced more and more. So there is very little evidence in the West of anything in the way of recovery in terms of home prices. If I then look in Queensland, I was talking to somebody the other day who was saying that prices up in Cairns are down now at least 10%. In the Wide Bay Burnett, they're also well down as well in some places there. In and around Brisbane, it's a bit more tricky. There are areas where prices are quite buoyant, particularly those houses quite close in to the centre of Brisbane, in sort of the 5 to 8 kilometre ring in and around Brisbane. Units, less so. We're seeing units being discounted now quite heavily, particularly new units. Some are now available at 20% below where they were asking a few months ago, and there's a bit air of desperation amongst new construction. Further out, if I go to some of those other outlying areas, beyond Brisbane itself, there we've got very high more levels of mortgage stress, very significant slides in home prices. And so we are seeing pockets of slides beyond Brisbane itself. My own view is that Brisbane is unlikely to hold value over the next 12 to 18 months. I'm looking at the leading indicators of mortgage stress. I'm looking at some of the other issues there in terms of supply, and we are going to see more property coming onto stream there. And then I should just cover Tasmania. So at the moment, Tasmania, Hobart is doing quite well, but in fact their growth has eased. In other words, the rate of growth is easing now, and I expect that to continue. There is still some appetite from interstate, but we're also seeing less transactions. Adelaide, a bit the same. Still some interstate activity, still some local activity, but I'm not seeing as much momentum there as previously. And so my expectation is that over the next 12 to 18 months, we will also begin to see some further slides. Canberra is holding value at the moment, but I'm also seeing massive supply, particularly of units. And there's early leading indicators in my data that suggest that unit prices are likely to slide over the next 3 to 6 months. The election may be part of that. Houses, a little less willing to slide in the short term, but perhaps a little later too. So generally my view on prices is that we're going to see slides rather than growth. Okay, going down the list, what else have we got to talk about? Is holding on to any property a worthwhile strategy, says Cody. Good question. Okay, so here's the thing. If you think of a property as somewhere to live, as somewhere to give you shelter, as somewhere to, bring up a family or whatever it is, then essentially you're going to be less concerned about whether the value keeps going up or even if it goes down a little bit. If that's your perspective, and I frankly think that's how we should be thinking about property, it is somewhere to live predominantly. Any capital gain that you might have got, over the last 20 years, that's unusual. Because, in fact, if you look long-term, the long-term trends for home price growth are actually pretty flat. There's been a couple of peaks when there was a little bit of a rise, and then a big rise in the last 20 years because of financialisation and because of freeing up the financial markets. But that's an aberration. So home prices don't necessarily always have to rise. And certainly there are still people who think that they double every 7 years or 5 years. No, I think it's unlikely. So from that perspective, if you think of it as somewhere to live, yeah, then roll with it and hold on. If you're thinking about it as an investment, I find it really, really difficult to be able to say other than as an investment, property will become less useful going forward. Not least, we'll get some changes to capital gains and negative gearing, perhaps if Labor gets in. We already know that there's very little growth. We already know that many property investors are thinking of selling because effectively they can't see any future way to make more growth. And in the meantime, a lot of the rental streams, particularly in Sydney now, are down a little, and we're going to see more of that. So it's harder to make it as an investment unless you think of holding it for a really long time. And I mean 10, 15, 20, 25 years. Chances are that over that sort of period, you'll be able to get some growth from inflation. But frankly, I think it's unusual, the growth we've had, and it may not be replicated unless, and this is the critical thing, unless we start seeing quantitative easing, in other words, the flooding the whole of the economy with more cash from the Reserve Bank. If that happens, we're likely to see a spike in assets, and that includes stocks and shares as well as property. But that's very artificial, and that will be supported by debt, and that will just create bigger risk down the track. So be aware of that. And what I say to people is, if you start seeing signs of QE and those sorts of things and prices taking off, be very, very careful, because effectively that could be a debt cat bounce. Okay, going down the list again. Banks are already loosening credit, I know for a fact. Their policies have passed down to the lending areas. Can't see a long drawn-out house price decline as a result. Views, that's from CDL. Well, at the margin, you're correct. There is a little bit more willingness to lend now. And of course, APRA gave them permission to effectively lend more interest-only loans. However, the lenders today are still complying much more with the lending standards that were actually brought into effect in 2009. So responsible lending requires them to investigate the ability of the individual to repay the loan and to confirm the purpose of the loan and to make sure that it is a sensible thing for that person to do. Now, for a decade, most lenders failed to comply with that, as the Royal Commission showed in the inquiry last year. So whilst I think there has been a little bit of latitude at the edge, my intelligence suggests that the banks are still lending more carefully and more cautiously. They're dialing back the loan-to-value ratios and the loan-to-income ratios. You can see that in some of the data already. And I know from some banks now are saying, well, if it's an LVR of, a loan-to-income of 6 and above, they look very, very hard. They still want more information in terms of income and expenditure. They want categorization. And some of that is risk transference. So what they're trying to do is to push risk back to the borrower so that if there is subsequently a question about responsible lending, the bank can absolutely prove that they have actually kept responsible lending standards appropriate. Now, the question, of course, is, and goes back to what the Treasurer said a couple of weeks ago, right? The Treasurer said, well, the banks should be lending more because we need that to drive the economy. The problem I've got with that is we've got very high debt levels already. And are you really saying that we need more debt in the system here? We've got some of the highest debt in the world. We've got some of the most indebted households in the world. We've got some of the highest mortgage stress in the world. no, my view is that we have to try and keep lending at a level which is long-term sustainable, because income isn't growing, cost of living are, and many households are up against it. So to my mind, simply saying turn on the lending tap and let it ride is, to my mind, just creating greater risk down the track. And it probably is going to be the case that we're going to see some unnatural acts before the election to try and sort of stimulate things a bit more. But I'm more sceptical than perhaps you are in terms of the truth when it comes to lending. We'll get more data in a day or two for the last cycle, and then I'll be very interested to see what happens in the next couple of months, and maybe I'll be proved wrong. But my suspicion is that lending will continue to be much lower than previously. And it really is that trajectory, right? Because for home prices to continue to rise, you don't just need credit to be growing at the same rate. You actually need credit rate of growth to be accelerating, because it's the impetus that actually creates home price growth. And as I've said on a number of occasions, I'll say it again, it is credit availability that drives home prices, and it's the lack of credit availability that takes home prices lower, and that's where we are at the moment. Okay, please talk about gold and Adam. I assume you mean John Adams. Okay, so you probably followed our series on gold. I think John Adams created quite a wave. In fact, we know that as a result of John's interventions, the Reserve Bank has now created another page on its website specifically talking about gold. And we know that there will be some questions asked in Parliament in February when the Reserve Bank governor is before the Senate. I believe it's the Senate. So it hasn't really gone away. With regard to Mr. Adams, though, yeah, he's gone very quiet. I don't know where he is. So maybe a bit later I might relay something which I got from him to give you a sense of where he's at and what he's doing. But I suspect you won't keep a good man down, and I think there's more to be told on the gold front later. Okay, Christopher says, can you talk about regional New South Wales? Yeah. It's difficult, of course. I can't go through every section of New South Wales, and I think I've got to find a way of getting more of granular information out there. Maybe I need to put more of my models up into the ether so people can see stuff. But basically, where we're at the moment is we've got home price slides in, for example, Newcastle and in Wollongong, on average about 6%, but in some cases considerably more than that. Looking over the divide, we're seeing prices under pressure in a number of other New South Wales regional centres. And that's really a partly supply-demand, but also a question of the drought, and also a question of lending capacity. So some of the lenders have dialed back their willingness to lend in some regional centres for various reasons. In fact, some of the smaller lenders are more proactive in regional centres than some of the major lenders. So it's not as bad as in and around Sydney at the moment, but I do think there is going to be more downside in regional centres rather than upside. And I know we haven't seen as much growth up, and that's why I'm saying it'll be a more gentle slide. But there's very little to suggest to me that we're going to see a lot of positive momentum in regional New South Wales. Brad says, you put a video out most days. Yeah, pretty much every day. I've had this sort of wacky idea of putting out something every day, right? And I started a year ago and I'm still doing it. Yeah, there are other people who are behind the scenes and help me out, but a lot of it I do myself. But so, yes, we do recognise a number of people, particularly some of the contributors like Joe and like Edwin, like John Adams, and I can list a whole bunch of others too, who actually have been on site. The good news is I've got other people that I expect to be able to interview and talk with. I've got a whole long list of people I'm trying to arrange. It is quite complicated to do, but we will try and do that. And I'm still committing at the moment to continue to do a post a day. If the quality of the posts degrade, that's when I would actually review my strategy of doing it daily. But at the moment, I think the quality is still there. So we'll keep it going. And we've actually upped the production values with the green screens and a little bit more use of stock video and those sorts of things, just to keep the production levels up. Okay, Edmund says, can you talk about how income affects rent? And yeah, it's a very interesting question. So if you look at it long term, the long-term trends, essentially the strongest correlation for rentals is actually income. So the theory that as home prices rise, that automatically translates to higher rental streams is not correct. That's why in many cases we're seeing investment properties underwater from a net cash flow perspective. There is a cap on what people are able to effectively pay. Now, in some cases, what we've seen is some property investors switching one renter out and then trying to get another renter in at a higher level. And some of that was working in some places, but I'm seeing it less of it these days. And again, in New South Wales, and particularly in some of the Sydney areas, I am seeing rental streams now quite a lot lower. We're seeing it in Perth too. We're beginning to see it in some areas of Melbourne too. So I think that the strongest correlation is still to average incomes. And there will be some variations, and clearly in some cases people are able to put the rent up. If it's a really desirable property in a very, very nice area, with certain amenities close by, it can command a premium. But a lot of rental property is in a sort of not quite such flash areas, and there the correlation between income growth and rental growth is pretty clear. And that's, by the way, rental and income growth after inflation. Okay, just going down my list, see what else I've got here. Is there room for something worse than Iceland 2.0? Yeah, well, I guess if you talk to John Adams, he'd probably say that, the worst case is probably worse than that. And the thing about this is we're talking theoretical models as to what may happen, and there are lots of variables, and it's very difficult to be able to actually model all of these things. I think that Iceland, which basically Iceland said, no, we're not going to comply with central bank guidance as to what to do, or from Europe. We're going to actually deal with it. We're going to allow a crash to happen, or we're going to deal with the crash, and we're going to grow beyond it. And that's what they've done. And in fact, in many ways, Iceland is a really good example of how to deal with the worst case scenario. But there were a lot of crazy things that happened along the way. A number of banks failed. They also didn't pay deposits to international depositors. And in fact, banks in their own countries actually ended up compensating international depositors who put money with banks in Iceland. So created a whole bunch of waves. But I think, Iceland 2.0 is probably a reasonably good worst case, but there is probably a little bit below that. But frankly, I haven't been able to model it yet, so that's why I do what I do there. Okay, anything else coming up? Oh, okay, the Aussie dollar. This is Mike. If the Aussie dollar is weak, where is our money safe? Gold or other international currencies? Yeah, this is a tricky one, right? So, it's really a big question as to what we think the Aussie dollar is going to do. Now, I've said for some time that I still think we're going to likely see the Aussie dollar lower than 70. And of course, it went to 67, 68 briefly, and then came back. It's at 72 now. That's more to do with the weakness of the US dollar rather than the strength of the local currency here, in my view. And it does depend on what happens to the US dollar. There are many people who argue that the way to deal with some of the risk mitigation we're talking about is to effectively assume that the US dollar will maintain a level of strength into the next 12 to 18 months or 2 years, and use that as a bit of a hedge. And there are people doing that. I put out a post earlier in the week with regard to crypto, and look, I haven't tried to cover the whole of the crypto world in one post, but I was trying to answer the question specifically, is Bitcoin likely to sort of bounce back? Because of course it's at 3.8, whereas it was at one stage close to 20. And my view is that Bitcoin is unlikely to bounce back anytime too soon. So I don't think crypto is necessarily a very good hedge in terms of risk mitigation. And I guess, the question is could also be the case that we have, changes to some of the international balance of power. As I said earlier on, maybe the US dollar ultimately loses, momentum. And then the question is, what replaces it? Could that be gold? Well, there are people buying up gold big, particularly in China and some other Asian countries, and I think they're taking a long view of that. There are other people buying up other metals with a view to the same thing. So there is no simple hedging strategy in this very complex environment that we're in. But my own view is, in the short term, the US dollar is actually not a bad way to think about it. Now, let's have a look. I saw a few... Whoops, I've just lost my chat, sorry. Okay. Let me just go back to here. Right, sorry, I just need to find my place. Okay, this is one from Baber. Why hasn't the government tried to promote lending and investment in manufacturing or business over real estate? That's a great question. The thing is that banks have decided that the real estate sector and lending for housing is just so simple because the risk profile is very good, very low losses over a long period of time. They get capital benefits thanks to the Basel rules. And all of that suggests that effectively you can make better returns if you're a bank from lending to the real estate sector. And of course, for a generation or two, with property prices rising very quickly, with mortgages being able to be given away to pretty much anybody who's got a pulse, the business model seemed remarkable. And then, of course, they could fund their growth using international access to capital because the international investors were happy to buy Australian bank bonds. Around 30 to 40% of bank funding is from international, and a lot of it goes back into the property sector. And then you've got that sort of momentum that as property prices go up, you create more value, you can lend more, you can grow the balance sheet, you can lend more, you can borrow more. So you can see how this self-perpetuating engine developed. But it was at the expense of real lending to real people in the business community. And if I talk to a lot of business people, as I do through my business surveys, there are lots of people completely unable to get funding that they need to make their business work. So as a result of that, what it means is that there's a relative sort of priority between investment for business and investment for other means, I guess government, but also now focusing in on the housing sector. So the housing sector has been the champion thing. Now the question is, should the government intervene in some way to direct the current banks to re-lend to the business community? I mean, they talk about open market and they talk about, market forces, so that's tough to see that. Of course, there are people who argue that what we need is a national bank to lend specifically for commercial and real investments in business. I think there's a lot of merit in that. But I think we have to go back to the Basel rules, because the Basel rules effectively have weighted the game so strongly towards lending for housing compared with lending for business that the whole supervisory framework effectively drives banks to that direction. So if we wanted a different outcome, we actually need a different regulatory framework, because if, for example, the banks were to have to hold more capital for mortgages but less capital for business lending, that would actually change the game. So I think there are some levers that could be pulled, but it's quite tricky. My own personal view is that you're not going to see the government mandating banks to specifically lend to the commercial sector over other sectors. I don't think it'll happen. Okay, what's this one? Why do government bail out banks instead of borrowers? What's the effect of guaranteeing loans rather than bailout. Okay, I knew we were going to touch this. I had a lot of questions on bailout and bail-in. Let me just, I cover this on a regular basis, but of course it also does evolve. So the thing to understand is that there is basically an international philosophy that was brought in after the GFC to say, we don't want a situation where if a bank or banks crash, they're bailed out by the government. That's what happened in the UK, that's happened in the US and elsewhere. Billions and billions of pounds and dollars were spent basically from taxpayers' money buying assets or buying pieces of the bank. And it cost a generation, frankly, in terms of the economic impact. So the argument was, is there a different path that we can produce? And effectively, the G20 and the bank supervisory bodies, particularly the Financial Stability Board, basically said, here's a different way to think about it. So bailing in and bailing out. So bailing in basically says there are classes of assets that banks hold, particularly bonds, for example, which are convertible bonds, that could be converted into equity if a bank gets into difficulty. And essentially that allows the bank to convert them at a point of distress and allow the bank to continue to function. So it's really a way of trying to keep banks going if they get into difficulty. And that difficulty could be lack of funding, liquidity, or it could be rising bad debts. Now, the problem, of course, we have then is, well, yes, but how far does bail-in go, and does it include, retail deposits? And they sort of redefine the way that deposits were thought about, because a lot of people would say, well, when I hand my deposits to the bank, they just look after them for me, and I get them back when I want them. No, actually, no. What you're doing is you're making an unsecured loan to a bank. And that change came in a little while ago. It's always been there in the background, but really it's only quite recently that this has come to the fore. So you are making a loan to a bank. It's an unsecured loan, right? And then basically what they say is, well, deposits might be bailed in, and in other words, might be converted to equity in the bank to help save it. And in New Zealand, there's the open banking regime, which basically is a very crisp and clear way of articulating it quite clearly in New Zealand. Deposits are available to bail in a bank in case of difficulty. And in other countries around the world, like Canada and the UK and areas of Europe, bail-in of deposits is pretty much there now. Now, in India, it was brought in, but then there was such a public outcry that it was reversed, so that's gone away again. And here in Australia, we had this very muddy legislation brought in last February, which basically said any other instrument could be bailed in, but nobody's defined what any other instrument is, and it's not clear whether deposits are in or whether they're out. And the fact of the matter is that if you talk to the Treasury and you talk to APRA, they say, oh, no, there's no intent to bail in deposits at all. Yes, never. But other people in Parliament have written rather different notes, and frankly, if I talk to the banks, as I do quite often, they say it's really unclear. So nobody quite knows whether deposits are in or out. My view is either it was a massive cock-up and they should have basically been very clear to exclude deposits, and perhaps they should bring legislation in to exclude deposits. And in fact, there are people on the back bench who are thinking perhaps that that's what should happen and are trying to encourage that conversation. Or was it deliberately obfuscated? In other words, following the international rules, the G20 and the Financial Stability Board, etc., was it deliberately obfuscated to allow the wriggle room so that in a worst-case scenario, deposits could be bailed in? It's really very unclear. So I can't definitively say, yes, deposits may be bailed in, or no, they won't be bailed in. Now, the other thing to understand is that the deposit guarantee, the 250k per account, doesn't come into existence until the government says it's in existence. So it doesn't exist now. It's a piece of legislation, but it's not until it's activated that it becomes active to a particular bank, and it's limited to 250k per a relationship. And bear in mind also there's a cap on the total amount that's actually guaranteed as well. So it's somewhat limited. It has to be activated, and it will only be activated when a bank has fallen over. So it's a way of getting your deposit back. So a lot of the politicians, when you write to them about bail-in, which is saving a bank that exists but is in trouble, respond in terms of bailout the 250k and say, well, you've got 250k, so don't worry, right? They are messing the two things up. So the question is, are they doing it deliberately, or is it they don't understand the difference between bailing in and bailing out? My own view is that there is further work to be done here to clarify in Australia the situation. It's very clear in New Zealand, their deposits are available for bail-in. And of course, recently in New Zealand, they've announced higher ratios of capital to further protect the banks, to make it less likely that deposits will be bailed in. I think we're going to see higher capital here in Australia too, but there is a risk. And the problem we've got is that it's very hard for individuals to try and recognise the amount of risk in a particular bank. The data isn't available there. APRA doesn't actually publish risk profiles of individual banks. You've got to look at the individual disclosures of individual banks, and it's not clear. In New Zealand, the Reserve Bank in New Zealand has a dashboard that they've published, which gives information about individual banks, so they're trying to help people decide, but that information's old anyway. So it's really tough to try and figure out whether a bank is risky, whether it's not risky, how much risk is there, are deposits safe, aren't they safe? I'm sorry that I can't give you a definitive answer to that, but that's the story. So it's a very unclear situation. We are pushing very hard to try and get the legislation amended so that it is clearly excluding deposits. But I think we're going to have a problem with that because, like I said, the G20 and the Financial Stability Board are both saying bail-in is one of the tools that should be there to deal with a bank in difficulty, as well as a living will for a bank and a plan for an orderly migration. Okay, what is the impact of valuations on acquiring credit on questionable construction? Opal Tower, Edwin, yes. And I think I saw that Edwin had made the point just below that the valuers are now taking a much more conservative. This is a big, big deal, right? So the Opal Tower thing is a microcosm of a much broader problem insofar that we've got self-certification processes in place. We've got very large buildings being built on areas where perhaps the foundations aren't necessarily as good as they should be, particularly going deep into mud rather than into the bedrock around Sydney. So the question is, are the building regs right? Is the construction right? Has it been certified right? And what do you do when you've actually got a problem in a building? Because there is this sort of migration path between the developer and then the manager of the building beyond the development phase. And quite often the owner community that is actually responsible for the day-to-day maintenance and management of the business, the building beyond, doesn't necessarily have full recourse back to the construction teams, particularly as in many cases the construction team disappears. So it's a big deal, and the report that came out today is pretty much says very little other than, well, we know that there are some problems, but they don't know the cause of the problems. And if you've seen any of the Edwin videos, in fact, I put another one up tonight that Edwin did when he talked a little bit at my prompting on what should people in high-rise towers be doing. You know, should they be concerned? And if they are concerned, what should they be doing? So look at that video. I'll put a link up in the chat post as well. There are things that you can do, but it's all about getting involved and trying to understand what's going on. So this is a really big deal, but we're already seeing some lenders now dialing back their willingness to lend to some high-rise developments in certain postcodes. And we're also seeing now property valuations definitely off. I saw a report the other day of a 16% drop in typical valuation in some high-rises in some areas. So this is going to be another downward force on property prices. But let me make the point, this isn't just in Olympic Park or just in Sydney. I think this is a national problem. I think we've got issues with construction quality, and as Joe Wilkes showed in New Zealand, potentially got the same issues there as well, where there's a lot of building going on which look to be speccing just to the minimum. And the question then is, are we actually building buildings for the long term, or are we building them just to flip and sell and not worry about whether they're around in 5, 10, 15 or 20 years later? So I guess the question is, are we building for the long term or not? And I think Edwin would say, and other people would say, we've got a big structural issue here with lots of cross currents in terms of personal interests and state interests and builders' interests, and it's all about short term yields and returns on building property in the place of perhaps more solid construction and better processes in terms of the long-term build. So this is a big deal. We're going to see a lot more of this, I think, and we haven't seen the end of it yet. Nice background, says Bester. Thank you very much. Yes, there is clearly a running joke, correct. I've had more complaints about my background, and when I say my background, not my education background or my work background, but the background behind me. So I invested in some green screen technology over the Christmas and New Year period, and I'm using green screen now. And this background is, I thought it was a little less formal than my blue one. This is why I'm using it today. Yeah, so other people are improving it. Good. I like that. Okay, what else have we got? Okay, this is from Simo. How do you think SMS self-managed superfund property investment with limited recourse mortgages will impact the market dynamic? Yeah, good question. Look, it's still a relatively small proportion of the total market. It's somewhere about 3 or 4% of property bought through self-managed super funds with limited recourse. And basically what that means is you don't have any recourse beyond the fund, which means that in a downturn, the fund could potentially lose quite a lot of value out of that particular property. Or indeed, if they couldn't service the property, so the interest on the property, there's nothing else behind it. So that's the problem. The problem I've got with this is that self-managed superannuation and superannuation in general is about long-term wealth development and creation for retirement. And in the current environment, it's hard to see how property is going to actually service that need in the next 5 to 8 years, in my view. So I think people need to be really cautious. I think a lot of people went in, got highly leveraged. They were often advised by mortgage brokers or real estate people or even accountants to do this because of the tax breaks. But if you look carefully, some of the tax breaks aren't necessarily so generous as you might think, and there are other things going on which could suggest that later we may even see less good returns in this area. And of course there is a debate about whether in fact this sort of recourse should be available. The Murray Financial Service Inquiry recommended it should be abolished, and there are other people also angling for that same story. Whether it will be grandfathered, whether it wouldn't be, I don't know. But no, this is a big deal. There is, of course, a broader question around superannuation, and I did a post the other day about the question of whether superannuation is actually working well for people, and basically the Productivity Commission report said no, it's not. A lot of people are getting very poor returns. A lot of people are not clear about what they're actually paying for those returns in any case, and there's some substantial reform that needs to be done. Bearing in mind also, of course, that many superannuation funds are investing in a portfolio of assets, including property and shares and those things, and even in some cases, maybe even in metals. As the stock markets internationally gyrate, as they have been gyrating, that's going to have a direct impact on superannuation as well. So, like it or not, anybody with a superannuation fund is exposed to the financial markets and all the risks and everything there. But I do think property and self-managed super funds are a bit of a risky issue in my view. Okay. Beaver's asked, is there any reason why we shouldn't renationalise the CBA and ban private banks after this? Oh, well, okay. The question is, what sort of banking reform do we need? I think we do need reform. I think the banks have done us a very poor service. The Royal Commission talked about greed in the banking system and short-term profits. Now, of course, banks are commercial entities, and they're there to maximise returns for shareholders. But that doesn't mean that they should be, one, breaking the law, and two, they should basically be taking their customers to the cleaners, which is what happened. So we need a different cultural base for our banking system. And I guess the question I have is, are the people in charge of the banks currently able to switch to this new way of thinking where you put customers at the centre rather than actually just pure profit. That's a really tricky thing to do, and perhaps we won't. And then the question is, if you don't think that can happen, do you then look to restructure the banking system in some way to be able to actually change its centre of gravity away from short-term profit motivation toward long-term investment and long-term growth and long-term customer outcomes? And there are different ways you could do that. Some people would claim that the way to do it is to actually pull some of the banking system back into a national entity again, and nationalise it and make it not for profit. Make it drive effectively to other outcomes. That may work, but that would fly in the face of 25 years of rationalisation of the banking system and commercialisation of the banking system, and there will be huge opposition from within the banking sector and beyond for that. Or do you effectively try and encourage alternative players like fintechs and some of the new players to come in with different value propositions? That's why the Royal Commission report in a couple of weeks is going to be so critical, right? So I think they're going to call out the greed, they're going to call out the broken rules, they're going to call out the change culture, the poor regulation from APRA and ASIC, and I suspect they will make some recommendations in terms of changing the structural parameters within which the banks work. I don't think they're going to come out and say nationalise or come out and say do Glass-Steagall necessarily. Although personally, I think there's a very strong argument for separating the speculative activities from banking to the core banking issues, which is why I think Glass-Steagall is probably a good thing. Would change the game. I also think there's an argument to say banks should only be able to lend up to the amount of deposits they hold rather than actually this multiplier effect because of the capital markets and all of that stuff. But remember that the thing about banks is that they create loans out of nowhere. So if somebody wants a loan, they can always get money from the markets to create that loan. And the outcome of that is an asset or a deposit. So this turns the whole banking system on its head, because most people still think that you start with the deposits and then make loans. Other way around, actually. You start with loans and then you make deposits or you grow assets. And that shows you that as the access to international capital continues to flow, that allows banks to grow and then lend more, and that then inflates their balance sheets and inflates the home values and those sorts of things. The reverse is also true. If the international capital markets gets strangled, if liquidity stops, as it did in 2008, then effectively the reverse is true, and suddenly banks no longer can lend, and therefore we see this very much tightening of credit. And at the moment, the ability to get capital internationally is still there, but the price is quite a lot higher, which is why mortgage rates are likely to be higher ahead. Okay. What do we got? What else? Yes, Mo says, I hope we get our gold back. Yeah, well, according to the Reserve Bank, no, the gold is staying in the UK, despite the fact that we don't necessarily know it's there and we don't have control over it. But there you go, that's one of those things. Okay, now, she says, on a scale of 1 to 10, how risky is deposits in banks? Well, I've tried to explain the problem, okay? So we know we've got the 250k government guarantee that could be triggered if a bank fails. And that is there, although there are limits around how much can be repaid overall. So there is a backstop, but only when a bank has fallen over completely. They've also got the bail-in thing, which we've discussed previously. So, and we don't know whether bail-in is actually legit or not legit for deposits. My own view is, and this is what I've done, is I actually have got money with a number of different banks below the 250k, and I've tried to spread it towards lower banks. In other words, not the big international banks, but local banks, some of the regional players, and some of the community banks, because they have much higher capital, much lower risk appetite, and therefore perhaps are more secure. That's my judgment. Could be wrong, but that's what I'm doing. I still don't have too much worry about deposits at the moment because of what I'm seeing in the banking system. Now, if that changes, and it could change quite quickly, then all bets are off. But at the moment, I don't think we're at 8, 9 or 10. I think we're at sort of 2 or 3 in terms of risk. And here's the thing. Any investment you make, whether it's in deposits, whether it's in gold, whether it's in stocks and shares, whether it's in property, they are all risk laden. There is no such thing as a risk-free investment, and that's the thing that people need to understand. No dead certs, and if you see a dead cert or if you're offered a very high return, don't believe it, because it's not the way that things work. Okay, this is from Count Chivas. What are your thoughts on the IDCEC champions of a national bank issuing its own credit based around infrastructure projects? Yeah, I think I sort of touched on it, but I will just touch on it a little bit further. I think there is a problem. We are not getting the funding that we need for building Australian infrastructure, which is required intergenerationally speaking, right? We tend to take short-term decisions and, easy little things, quick fixes. I think there is a vision thing missing here about the nature of Australia and what we want to see long term. Probably a bit the same in New Zealand, by the way, as well, although I don't know as much about New Zealand as Australia. The vision thing requires funding that is able to be used for long-term investment and building nations. That's what we need. And at the moment, we don't have enough to do that. So my answer is I think the CEC is onto something here with a national bank. But there are some questions about how it would be governed and how it would make the right decisions. And of course, the traditional argument has always been that a nationalised entity is intrinsically less efficient than a private sector entity. But I would answer that differently to say, well, actually, a public entity that's there to create long-term growth does not have to make a 9 or 10% return, or even more, 12% return on capital, whereas a private sector entity always does. So by definition, a private sector operator is always going to be 10 to 12% off the pace when it comes to creating value. So there is potentially more value to be created in an infrastructure bank that's owned by the nation. So I'm pretty much in favour of this if it's carefully crafted, if it's carefully scoped, and if it really does prioritise and focus on the right things. But that, of course, is another question. Okay. Now, this is from the new Voice 8. Build quality. Should we not be charging the system or changing the system so that those that sign off on building are not from private companies? Yeah, I tend to agree with that, actually. I think we've basically shot ourselves in the foot by outsourcing all of this certification to private operators who, frankly, are paid by the builders to do the certification. So there's an implicit conflict of interest. Some will do a great job, others may not. I think we need a better system. So I hope that other back off Opal and everything else, we get a different approach to certification, but we'll probably take some time to get there. Okay, Mike says, if the dollar is weak, Aussie dollar is weak, where is our money safe? And what do I think is going to happen in the next 2 to 3 years? Look, it's hard for me to see how the Aussie dollar can maintain its position above 70. If you look at the long-term trend over the last year or so, it's down. There's a lot of reasons why I think it will go lower. I think the Reserve Bank may cut interest rates. I think they will sacrifice the dollar to QE the economy as momentum eases. So my view is we're likely to see the US dollar drop. But of course, we will import inflation at that point, because effectively stuff coming into the country will cost more. That will be an issue, and that will then perhaps work against it. And we might get, as a result of that, sort of areas of hyperflation. We might, on the other hand, get deflation. So it's one of the things that is the fact it's very hard to call these different scenarios because there are so many different potential outcomes. But my base scenario is an Aussie dollar well below 70 over the next year or two. And what that means is that, and you need to find an alternative hedge. Like I said, US dollar looks to me in the short term to be one that's perhaps worth considering. But that isn't advice, that's just a thought. Okay, let's have a look. Freddie says, I know you can't rank the banks publicly. Can you let us know which banks your money is with? No, I can't name them. But I've told you, I think, that they are smaller banks, credit unions, mutual banks, players who are effectively, in a local area, can also see them on the internet. They have a much higher capital ratio. They're much less exposed. They're much less likely to be exposed to international funding pressures. And so my own judgment is that they are perhaps a little more secure than some of the big guys who have derivatives, massive exposure to derivatives, as well as exposure to housing and also exposure to international funding. So that's what I've done. Okay, Superluminate89 says, if bail-in doesn't work, will you still get the insurance? Are you legally a shareholder and get NARDA? Well, that's a very interesting question, right? Because the interaction between bail-in and bail-out is the question, right? As I've told you, bail-in is to keep a bank going longer. So what happens if you're bailed in, you become a shareholder, and then the bank falls over? Have you then effectively foregone your deposits and you're now a shareholder of the bank and that disappears? There is lack of clarity as to precisely how that would work. It does seem to me to be suggesting that the amount that would be available to be protected by the deposit scheme would be the amount in a deposit account at the point when the bank fell over. So it seems to me that you could well be in the situation where your bail-in happened, you've lost some of your deposit, then the bank falls over, and then your net deposit is what's covered by the bail-in. By the guarantee. Hard to tell. There's no clarity. There's no rules about it that anybody's published that I've seen. APRA is very vague about it. I've asked a few times, haven't got a reply. So I'll keep drilling on that. I'll keep burrowing away and trying to get an answer. So Balik says, along with the housing market, the banks will fall like dominoes. No nation is immune from this coming global economic collapse. Well, see, it's very interesting, right? Because a lot of what I've been talking about is based on the assumption that the local economy here will have some difficulty. Inflation will probably not ride up very much, but the GDP will slide. Unemployment will begin to rise again. Bad debts will continue to rise, and home prices will continue to fall. That's sort of the local scenario. But there's an international context here, and you can talk in geopolitical terms, in terms of China and the US, the Middle East, all those things, Brexit. All of those things have potential significant impact, plus the fact that you've got this massive debt overhang in the US. A lot of bonds were issued in the US by corporates at very low rates. Those interest rates are now rising. A lot of them were done for buybacks. We know that there's a lot of debt in the US from other sources. We know that there's big debts elsewhere in the world. And of course, global debt has never been higher. The World Bank made that point recently, and I covered it in one of my posts. So we have an international context where we didn't learn the lessons of the 2008 crisis. We've got huge amounts of debt in the system. And essentially the only levers we seem to have is to do more debt again. And whilst the Fed is trying to lift interest rates and effectively trying to squeeze the balance sheet of the Fed, and now the Eurozone is also trying to dial back some of their stimulus as well, the fact of the matter is the levers that seem to be available are more debt, more stimulus. And it's interesting that Bernanke and Janet Yellen both recently in a round table said that the systemic risk that we've got and the high level of debt we have in the system here globally are risks that we don't yet have the tools to manage. So there is this international context which suggests there could be some issues ahead. Now, of course, there are a lot of YouTube channels out there saying, oh, it's doom and gloom, it's all going to fall over tomorrow afternoon, right? I'm not sure that's the case. I think it's probably going to take a lot longer to work through. But there are a number of leading indicators, and I've tried to highlight them in my regular posts, that suggest that the level of debt, the level of derivatives, the banks in particular are under some pressure at the moment. And I look at Goldman Sachs and I look at Deutsche Bank as two sort of leading indicators of banks who are right in the maelstrom here. We are in for a bumpy ride, I think is what I can say clearly. Whether there really is going to be a global meltdown or whether we're going to see more little bushfires around the place and, a little bit more stimulus here and those sorts of things, have to wait and see. Remember that some of my scenarios, particularly the later ones, assumes an international crisis comes in over the top. And I still think it's quite likely, but timing, of course, is the question. Okay, I think I'm pretty much done on those. So what I'm going to do, I'm just going to go back to my PC screen now, because if I go there and go there, these were more questions that I actually were given a little earlier on, and I thought I'd just cover them off. Hang on. Okay, this is now. Sorry, I'll do this first. This is from John Adams. Now, I don't know what happened to John, but this is what a statement that he sent to me a little while ago. So, during the course of the previous months, elements of Australia's establishment have opened several overt and covert fronts of economic and political warfare against me, this is John speaking, for speaking publicly in the interests of the Australian people. Given these extraordinary events and the coming economic Armageddon, I have been forced to undertake extraordinary personal measures that will allow me to continue to warn the public in 2019 of the perilous state of the Australian and global economies. Hence, in recent weeks, I have been consumed in putting in place those measures which has limited my ability to speak on the public record. For those who have accused me of treason, of missing in action, lacking gumption, or abandoning the cause, I say to you that it is an error to assume that my recent silence is a sign of cowardice or surrender. Quite the contrary. Never has my passion and resolve been stronger. Come what may, I plan in 2019 to speak my mind and to take a stand for the Australians of today and for the Australians that are to come. That is the ultimate quest for those who wish to serve the people. Let there be no doubt that Australia's great debt and housing bubble, covered with the now scandalous building disaster such as the Opal Tower, represents major crimes against the people. I, for one, do not intend to let those crimes go unaccounted for or unpunished. So there you go, statement from John Adams. I think, will probably be hearing more from John relatively soon. But the fact of the matter is that John is alive and well somewhere, even if we're not quite sure where. So there you go. Now that was, I thought there was questions there, but I've clearly got the order wrong here. So that was the John statement. Let me just go back to the switcher, and I'll try and find my questions now. Hang on a second. Okay. There we go. Okay, so just a few questions that people had. So Nigel from New Zealand said, just wondering what sort of advice you'd give to someone looking at refinancing to take a second mortgage to purchase an investment property in Sydney. Just asking on behalf of a friend. Oh, yes. You always do. Look, here's the thing. Investment property at the moment in Sydney or anywhere else is actually quite troublesome at the moment, because the returns are just not there. So you need to be very, very careful. If you really can find an investment property that is at the right price with the right returns, maybe even a guaranteed rental, you might want to do something. But be very careful, because if you are refinancing now, the banks might be quite keen to give you a refinance, but they'll also be asking some very hard questions about your ability to repay the refinancing and to make sure that you can service it. Be extra cautious if you're thinking of doing an interest-only loan, because that is actually extra problems too. But do your sums carefully, because a lot of people walk into an investment property just assuming that they can get negative gearing, just assuming that they can actually get the rental returns they need, and assuming that interest rates will never go up. Do your sums. This is a very dangerous time, in my view, to be going into the investment sector at all. Just my opinion, could be wrong. Okay, Carl said, love your analysis and content. Can you provide some insights into the 12-24 forecast for the Brisbane housing market and some advice for a prospective first-time buyer? Well, I've covered the Brisbane housing market in an earlier part of this conversation. In terms of first-time buyer, if you have got a good deposit and you are prepared to risk some of that deposit because of the fact that prices may go down, then it is probably not completely beyond the pale. But I think you'll probably find that next year prices will be lower than this year. And I think that you can probably buy closer in or better property at a lower price. So be very careful. Secondly, build your cash flow so you know what you can afford, not based on current interest rates, but let's say 3% above where they currently are. And thirdly, take account of the fact that what would happen if your situation changed in terms of work, or you started a family, or those sorts of things. With all those other external factors, when you go to a lender, they'll ask those sorts of questions now. And then finally, start keeping a record of what you spend, so that you've got at least a 6-month history, statements and everything else, for when you go to get a mortgage, because you'll need that, because these days a bank is asking for at least 6 months data to be able to lend. Good luck. I've talked about the Aussie dollar Don, I think, going down. But Don says, I love watching your content on YouTube. Can you give a brief analysis of where you think the Aussie dollar is heading in 2019? Down. It's a question of how far down. Towards 60 is my view in the next couple of years is the most likely outcome. But, so many external factors as we've discussed. Okay, Brett asked, to what extent is the present credit crunch being exacerbated by the banks flexing their muscle and attempting to reassert the influence over the political bureaucracy? Very interesting question. Have they over-tightened deliberately is the interesting question, right? Have they done it to basically teach everybody a lesson? To an extent, I think maybe a bit. But it's more, I think, to do with the fact that the wake-up call from the Royal Commission basically said, meant the fact that they could not continue to do what they were doing. Responsible lending laws that came in 2009 have not changed. The Royal Commission does not need to make any changes to them. They are there. They are clear. The banks are now, I think, responding to those rules as now clearly defined. Lawyers will still argue for a long time as to whether they're right or not. But I don't think, from what I can see, that there's a conspiracy behind the scenes, Brett. That's my view. Okay. Questions about bail-in. What can you protect him or HealthServe in the event of a bail-in? So I've said, I think, spread your risks. Don't have everything in one bank is the first thing I do. Secondly, keep an eye on what the banks are saying, and there's information that they report on an ongoing basis. You're right, leaving it under the mattress isn't necessarily a very good idea, because of course it could easily disappear and get stolen and those sorts of things. So deposits pay a very small amount of interest, very small these days. In fact, that's one of the issues I've got. Also bear in mind that, of course, that term deposits tend to pay higher interest rates than call deposits. But then you've got that limit of access, which is something as well. This is a tricky area. There is no simple, straightforward answer to dealing with where do I put my money. So it's down to you making your own decisions as to the relative scenarios you want to bet and back, and then the various options and alternatives. I can't really give you more specific advice than that, I don't think. I think there was one more. I think I may have answered this one, Cody, but basically, I think this is a long, slow slide rather than a short, sharp spike and then a return. So that's the way that I read it at the moment. Okay, so I'm just going to go back and see whether I've missed anything while I was on those slides there. Somebody talking about that. Walk the World, do you subscribe to the Money GPS? Oh, well, I do see them from time to time. I don't necessarily subscribe. I don't have time to watch a lot of other YouTube stuff, to be frank, because I'm doing primary analysis most of the time, and primary data, and then the video production. There are a few people that I do listen to and follow, but frankly not seriously. I tried to do mostly primary research and my own analytics, and using my customer surveys, because I think that's probably the best and most powerful way of doing it. The difficulty is, of course, there are many, many people that you could actually watch and listen to. Some of them are sort of just rehashing, articles and just highlighting things. Others do have a particular philosophy and a particular point of view and propagate that. Others have a very narrow and myopic view of things. And what I've tried to do here is to try and keep some balance. So I think it's important that we understand that there's a lot of uncertainty. And one of the messages I want to get across to people is you cannot find pure certainty at the moment. There are too many variables, there's too much uncertainty around. So you've got to be able to expect the unexpected, and you've got to actually understand that uncertainty and lack of clarity is par for the course. So anybody who thinks precisely that they know the answer and can predict precisely when things are going to happen are wrong, because nobody can. That's one of the reasons why I use scenarios, by the way. Okay, so I think we're pretty much there. We're running close to time, so I'm just going to go back and just finalise a few things, and then I'll just come back for any last conversations, and then we'll close it out. So just in terms of, if you get value from what we do, and we put a lot of time and effort, and Joe Wilkes and other people too are all helping me with creating great content, but there's a lot of work to do. We are absolutely dependent upon your support, and of course we do have the Patreon program. We have a lot of people who actually have signed up for that. You get access to exclusive content and early releases of information, behind the scenes videos, and a bunch of other things. So if you haven't considered Patreon, do look at that. I know that some people have issues with Patreon and the way they do it, and it's US dollars and those things, but nevertheless it's a really powerful platform. There's also a lot of ability to interact via Patreon. So that's one thing that we do. The other thing we do is we also have now the ability to use PayPal directly. So you can actually make a direct contribution, one-off contribution, or whatever you like, directly via PayPal Me. A lot of people have done that, and that's very helpful. So I really appreciate all the support that we are getting. It really does make a difference between us being able to produce the content and the analysis and the quality that we want to. It means, of course, that I can spend more time doing this sort of stuff and less time working for clients, which is actually quite helpful. So PayPal there, please. We're also trying to look at a Bitcoin alternative. People have asked me for that. I'm a bit skeptical of Bitcoin, but if people want to use that as a channel, I'm going to try and find a way of doing that. So watch out for that later. Somebody said the other day, well, how can you be a skeptic on Bitcoin but also offer a payment platform? To which I said, well, if somebody wants to pay me Bitcoins, who am I to say no? Also, just to underscore, there is the Digital Finance Analytics blog, which contains a whole lot more information. And one of the things that I'm trying to do is to get people to understand that even if for any reason, we disappeared off YouTube, the DFA blog is there, and we have a lot of material, a lot of content, a lot of videos there as well. So check it out. You can subscribe there as well to receive alerts, as well as the YouTube stuff. There's a lot of other posts that we do as well. So the DFA blog is worth a look. There's a lot of material. It's been running for 8 or 9 years now, so it's got quite a lot of history. And then finally, just the top hits of the month. Very popular post was the debt juggernaut grinds on, when I talked about the amount of debt around the world and how big it was and what needs to be done about it. The fact that News 24 used me a couple of times over the Christmas and New Year period, I guess I was the only one around, but who knows. Did it via the green screen here, so that's actually me on my green screen. You can probably see the colours are a bit off, experimenting early, but nevertheless that was quite a popular one, and there's a couple of others there on News 24. There is, of course, the famous John Adams assassinated video, which got a lot of views. That, of course, was before Christmas, and we know that John is somewhere. We're not sure exactly where, so watch that space. I think we'll probably end up with a new channel with John and I are working together on that, so that we can protect the rest of the DFA sort of line of arguments, but also take the joint work with John further and get into more of the political, financial and economic nexus. Edwin Almeida, most recent post came out today, but this is the previous one talking about how to prepare a property for sale. Some great tips there. Somebody said they'd basically save thousands by taking some of those tips seriously, which is good. I did this post on crypto, not meant to be definitive. I'm going to come back and talk about crypto banks and about some of the crypto payment systems that are around. But I wanted to put a stake in the ground with regard to what I thought about the future of Bitcoin, and the value of Bitcoin. So that's what that one is there. And finally, we do the property imperative weekly, each week. Still summarising, still essentially giving people the flavour of what's going on. We incorporate international data, local data, a lot of charts and graphs and things like that. And then finally, just before I close out, let's go back to there. Let me say, if there are particular things you'd like me to study in 2019, drop me a note, send me an email, send me a chat. You can always contact me via the blog, the DFA blog directly. I am going to get round to bringing back the next capital market program, the Capital Market 202 program. I've got some more of that done. I just haven't got it up yet. There will be more from Edwin. There'll be more from Joe and other people too. More guests planned as well. And we'll be doing another live stream in about a month's time when the Reserve Bank's minutes from February will be out. So that'll be the third Tuesday again. So I'm now going to come back to look at here and just see whether there's anything else. Have I missed anything important? Probably. Okay. In your scenario where the RBA lowers the cash rate, the higher percentage of lower house prices, can you explain a bit further? Yeah, I can do. Let me just go back to that slide. If I can just find it, and I'll bring it back up. Okay. Screen, go back to that. Okay, so just to answer the particular question. So the home price movements, there's a range there, and that's because different locations will essentially have different movements. So, for example, in the case of the not yet doomsday, 20 to 30%. 30% is what I'm calling for units in Sydney, for example. 20% would be some of the areas outside of Sydney, New South Wales, and those sorts of things. So it's trying to give you a sort of a rough indication. It's not a zero bounds. There will be locations where prices will be further down, and others will be down less. But it's sort of the 80% bell curve, I guess, is what I'm trying to give you a sense of. And 20 to 30 is, if you like, my best case. And by the way, 60 Minutes is collaborating with me on another program, which will perhaps happen in 2 or 3 weeks' time, all being well, where we're going to talk further about home price falls and how it's going to play out. So watch out for that. I'll provide you with more information on that a bit later on. Okay, well, we're coming up to the end of the show, I think. So I hope that you found that useful. I really appreciate your time and your contributions, and particularly the questions. I hope that I was able to answer some of the questions. I probably haven't answered all of them. If there's something specific that you want an answer for, send me a note specifically, and I'll try and handle it offline. It is quite complicated to try and manage all the live chats and everything else at the same time, but I think we do it reasonably well. I hope that you found it useful. I hope that you get a bit of a sense of some of the issues that I'm dealing with, and certainly ahead, there was a lot more to come. Somebody's asked just a question: how big is my sample? 52,000 households a year, 4,500 a month is the way the samples work. So it's a 0.05% national sample across Australia, statistically optimised. So that's the way it works. Okay, so appreciate your time. Have a good evening, and I'll look forward to seeing you again soon. And keep following the channel. Keep leaving quotes. Also, please refer the channel on. Do retweet, repost, spread the word. We got quite strong growth in followers over the last month, and that's great. I want to continue that momentum as we move forward into 2019. So thank you very much for your time, and take care, and we'll talk to you again soon. And this is where I now push the end button, and hopefully it'll all work. Fingers crossed.